Hi everyone, welcome to my Personal Finances Podcast, episode 57. Today we're going to talk about how to mitigate risk while investing with Dato Eu Hong Chew. So, Dato Eu is a value investor with his blog at i4value.asia. His articles are regularly featured in iproperties.com and also Focus Malaysia. With his vast experience in value investing and also his role in risk management community, let's open our mind and learn how to invest in stocks without putting our money at risk that we won't be comfortable with. So without further ado, let's welcome Dr. Yu.
Hi,
Hi Dato. Hi, welcome to the show.
fasting man.
Um,
So, for those of you who are fasting, you should be working so that you can go home early.
yes, correct. Yeah, and also like to not be too sleepy. Let's join us while we learn from Dato You, right? That's why we have you on this show. Now, let's for the benefit of our audience, could you please briefly introduce yourself?
Okay, I'm 69 years old. Okay, and I say that because I studied at the Royal Military College from
Mhm.
the class of 69 to 72. And this year, all of us who entered in 1969 are now 69 years old. So we're going to have, notwithstanding the COVID, we are planning something, somewhere in June or July to celebrate our 69 years old.
Oh wow, that's interesting. That's so meaningful, actually.
Okay. So it's very sad because there were 100 of us who actually entered, as Form 4 students in 1969. Out of the 100, I think there are probably about 91, 92 of us still left. Okay, so some of them really don't make it. So we are a generation where every year the numbers get less and less.
Wow,
But
that's life.
I,
But
I
I think.
well, I studied engineering in Glasgow,
Mhm,
Glasgow University,
mhm,
and then I
mhm,
did my master's in Bradford. And
mhm.
for the past 20, 30 odd years, I've been working for a company that most of you may know. I was a CEO for ICT for many years until I retired a couple of years ago.
Mhm.
ICT is famous for the city of digital lights, among other things.
Yes, we understand.
Although we like people to recognize for property development, most people think of us as the leisure place rather than actually the property developer.
I know. That's where the youngsters go take their Instagram and Facebook photos, right?
Yes. Uh, 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 and I will tell this story because when we started ICT,
Mhm,
it was a blank piece of land. It was an empty plantation land, and we had difficulty attracting people. So we decided to do this year of digital lights. And the
mhm,
idea was, the youngsters were like it was a Google strategy. We just want hits, just for people to come, And for the first few years, it was a free exhibition, free entrance for people, and it was
mhm.
basically Google strategy, get hits for people to come.
Yeah, and it worked perfectly, right?
Yes, yes. Surprisingly, although we always say with hindsight, yeah, okay, we thought of it, but actually those days when we first started, we were very skeptical whether people would come when you offer things for free.
That
It
made me
worked.
curious, who came up with the idea?
Well, the history of ICD was the master planner was a guy called Jody, and Jody was a planner in the US.
Mhm,
And for those of you who have been to Las Vegas, there's a
mhm,
thing called Fremont Street in Las Vegas where the whole ceiling was all lit up, and it's a tourist attraction. And he designed
mhm,
that. So when we told him we wanted to do ICT, he told us that lights have the power to attract people. Those days we laugh like, say, oh no, what made you think? But he says that whatever you want to do, play with lights, and that's how the
mm,
city the lights idea came about. So it was uh, Jody's idea. Okay, and
mm,
he is very famous because he also designed the Mall of America. This is the biggest mall in the US. Okay, and
wow.
there's a lot of other Las Vegas. He does a lot of work for Universal Studios. Okay, so a lot of the
Mm,
ideas are there, and we just piggyback
I
on his ideas to say,
see.
look, I know you want to attract the young people and so on. You have to do things that they find fun, and that's where we are. Lah.
Interesting. Wow. Now we know the behind the story of like City of Lights in Malaysia, which is like if it's there's something like new about it lah. It's one of the first in Malaysia back then. So then, what led you to where we are
So
now?
when I retired, and I stopped official work in 2019, just the year just before COVID, uh, 1 or 2 months after I stopped work, COVID hit us, and we were all locked in at home. And my son told me that, hey, since you're writing all these blog articles, all this investment for your friends and so on, why don't you go and blog it? Since you're stuck in the house and nothing to do. And that's how my blog started. Okay, to spend the time, while locked in the house.
That's
And
interesting.
one of the things that I found, okay, is that and that's the point I want to make.
Hmm.
You invest because you want your savings to grow, not because to
Hmm.
make money. Because if you don't invest, inflation will erode the purchasing power of your savings. So that's your main objective of
Definitely.
investing. Okay, don't think of making money. Think first of protecting your investments from inflation. And with
Yeah, that
that
is so
as the
true.
objective, the minimum you expect is of course the inflation rate. So we are
Yeah.
lucky in Malaysia, where we have 2 to 3% inflation rate. And when I say invest, it doesn't mean you have to think in terms of stocks or shares and so on. Your EPF is a good investment.
Hmm.
Historically, it has generated better returns than your inflation rate.
Hmm.
And I actually, in my blog, I actually have a comparison between the EPF and the performance of the KLSE. And
Hmm.
over a 30-year period, you actually get the same return because the
That's
KLSE is
interesting.
more volatile. The EPF is not volatile because every year they give you, 4, 5, 6%. And over a
Hmm.
30-year period, the returns with keeping your money in EPF
Hmm.
is as good as investing in the stock market for those of you who are buying the index.
Yeah,
So you
that
don't
sounds
have
like
to
a good
really
article to read up about.
yeah.
Yeah.
Don't
So
really don't try to do clever things.
yeah, so Dato. Yeah, thanks for the introduction about yourself. Now that we know that side of you, maybe like for the benefit of our audience, maybe like to just get to know the personal side of you by asking like the first question, which is what motivates you in life and work?
Well, I think that whatever you do, and it's a very strange thing to say. Uh, I always try to find something fun to do lah. Okay,
Mm,
so it's something that my chairman don't understand. Okay, he's an entrepreneur. He works hard, and so on. But I tell him that I'm here because I find that what I do is fun, and I think if you want to uh, survive long term, I think in a work environment and so on,
uh-huh.
then you must find fun in the work you do. You must
Yeah.
find fun in what you do, because if not,
Yeah.
everything is going to be very deary.
Yeah, wow. Like, it's only the first question, but I'm definitely loving it. I think this is so important. So many people, like, I mean, maybe it's the way we grew up. We were taught to, just, work for the money or, need to study hard or work hard. But really need to, like, enjoy what we do, or else, like, every day you won't even feel like waking up to do things that, yeah, to go on with your life, actually. Yep. Thank you so much for that. And the next question is what is your personal definition of financial independence?
Oh, good question. Financial independence. The ideal one is have money without having to work. Uh,
Mm,
that's that's the passive income dream of everybody. The
mm,
sad thing is, of course, that there's no such thing as passive income. Short of the only three ways: you either get married rich, that's the best passive income. Okay, you either strike the lottery, wow, better still. Okay, uh, okay. So there are no way to get rich through passive income, because the passive income is is a misnomer, because even for you to make money from investments, you have to work at it.
Mm-hmm.
If you think that you can just simply put money into the stock market or into some other investments and the money will grow, then I think too bad for you. You know, you have been duped.
Wow.
There's no passive income. You have to work.
Yeah.
Okay, whether your work is 9 to 5 or your work is investments, you have to work.
Yeah, wow, like no, again, like, thank you so much for the explanation. I think, yeah, I mean, everyone kind of have different definition about financial independence, but generally it means that, yeah, you sit down there and you think that you get the passive income by no, without having to work, but that is so not true. Like, yes, investment is something that we have to review and monitor and study, a lot of hard work that put into it in order to like generate income, like, or else it's really like back to what Dato mentioned, which is number one, get married rich, or second, strike lottery, which which has no point in like thinking about that, right? Thanks for that. And the third question is, for yourself, Dato, like, how do you save and invest?
Well, I follow the route of all the young people. So when you're young, the time, you know, and this is, when you first start to work and so on, you speculate. You listen to tips, rumors, and so
Hmm.
on, because that's the easiest thing to do. Okay.
Hmm.
And those days, you don't have platforms and apps like Robinhood and so on. So those days was actually, going to a stockbroker, looking at newspapers, and that's where you get the tips from.
Hmm.
Nowadays, with apps and so on, it's so much easier to speculate. Okay, so you
Uh-huh.
just get an app, punch the numbers in, and wow, voila, you think you have learned, you have invested, but actually you're just speculating. and,
Yeah,
and I
I.
want to tell you a story, because I tell this story to my children. You
Mhm,
know, if you want to be a mathematician, okay,
mhm,
okay, do you go out to the market and find out the best calculator? You know, would having the best calculator make you the best mathematician? When I ask a stupid question, you say no, because you have to learn mathematics. Yet when it comes to investing, you think that getting the best app will automatically make you the best investor. It's a very sad thing, but that's what people are thinking. Oh, if I get Robinhood, or if not Robinhood, which is the best app, it will make me a fantastic investor. Sorry, you have to learn investing. Getting the best
well, I
calculator is not going to be a mathematician.
I knew, like, for this conversation, the word of Robin Hood, like, the term will actually come out, and then there it is. Yes, I get your point. Yeah, which is sadly but true. That's what many people are thinking, that basically, people are trying to make things like simple, find an easy way out, and then people find like good solution. That's how people are making money from like developing all this kind of solutions. But down back to the point is that it's something that we still have to learn, and maybe learn from mistakes, and put in the hard work to study, and yeah, and then do a lot of research and read up about it, right? So yeah, does that mean like that's how you that's how you're doing your investment right now?
So it's a very sad thing, because I spent, probably the first 10, 15 years of my life speculating. And
Mm-hmm,
it's only later, when you say, hey, you know, how come I'm not making more than what the index is doing?
mm-hmm,
Then you begin to say, hey, maybe this is not the route to go.
mm-hmm,
And then you realize that, hey, you really have to learn to invest. And that's where I started, around, late 30s, early 40s, that I started to really learn investing.
mm, yeah.
And when I talk about investing, it is not just about the stock market, although the stock market is the easiest.
Mm-hmm,
In Malaysia, you have choices of the stock market. Uh, there are people who invest in properties,
mm-hmm,
so there are choices. It's just that the stock market is much more easier, and you can, with a small sum of money, you can invest in the stock market, whereas in properties, it's
mm-hmm.
a different ball game.
Yeah.
But
And
to tell you the story, okay, and for those of you who is thinking about stock market or property, Malaysia is a very funny animal, very funny country. Because when you read about what's happening in the US, in Europe, and so on, and you read the investment articles and so on,
Mm-hmm.
they always tell you to invest in the stock market because over the long run, the stock market gives you a better return than any other assets.
Mm-hmm.
But in Malaysia, and I've done this comparison, between the stock market and house prices in Malaysia
Mm-hmm.
over a 30-year period. Okay, there's no difference in terms of returns between the stock market and houses. It's a very funny feature of Malaysia that
Mm-hmm.
historically the returns from investment in property gives you as much return as the stock market. Of course, there are differences between property and the stock market,
Mm-hmm.
but the end point is about the same.
Wow. And this is only specifically in Malaysia itself.
It's the feature of I think it's the feature of the demand for houses in Malaysia and how we grew
Mm-mm.
up. But
Then does that mean like everyone should like be buying property
well,
and
uh, I think everyone should own at least one property in his life.
mm, mm.
Uh,
Yeah,
if nothing else,
definitely.
it is still the better protection against inflation.
Mm, yeah, definitely. Yeah, which comes to like asset diversification. Yeah, but it's one interesting when I heard about you say like investing in stocks is one of the easy one, which is kind of different from what we hear from many people who are not in this field because they think, wow, investing in stocks, I'm not sure if I can, I'm not sure if I know what I'm doing, and that's common in the investors in Malaysia, maybe the younger ones. What do you think about that, Dato?
Well, it's because there's been too much what do you call it news today, investment news. You
Mm-hmm,
got
mm-hmm.
CNN, you got Bloomberg. So
Yeah.
when you listen to them, you think that wow, they must be doing something fantastic and so on,
Mm-hmm,
and because of the way they talk and so on, many people think that wow, it's not something that I'm familiar with, so I don't want to touch it, and
mm,
it's quite sad, because of that perception.
mm-hmm,
Because when you talk about investing, and especially in the stock market,
mm-hmm,
I like to think that you can approach it in several ways. The first, of course, is the idiot way lah. You do it blindly, or you simply buy based on rumors and tips. Okay,
mm-hmm,
but leaving that aside, there are three or four other ways you can invest. The first, of course, is what I call the traders do. Okay,
mm-hmm,
so they look at the market prices, and then they say that, oh, this stock, the price is going up. I'm going to buy on that basis because I believe that the future price will be higher and so on. Now, this form of investing is like buying tulips. You are looking at stock as pieces of paper. You don't care the business,
mm,
and you spend your time trying to figure out the crowd behavior.
mm,
There's nothing wrong, uh, if for you to be successful, you must have the ability to read the crowd behavior because you buy the popular stocks. You buy
mm-hmm,
on the basis that the popular stocks, the one is going to go up. So if I can identify the crowd behavior, if I'm very good at reading where the crowd is going, I can invest in this manner. Okay.
mm,
Now, some people use charts, some people use trend lines, and some people use indicators and so on. But basically, it is all a proxy for saying this is how the crowd is behaving.
mm-hmm,
So this is one way of investing. Okay, you are investing based on what I call pieces of paper. You don't care about the business. You
mm-hmm,
care about what the crowd is thinking.
mm-hmm,
And there are people who are successful in this. Okay, but it's a
mm-hmm,
skill that you need to learn now. No?
mm,
The other way is what I call fundamental investing. You invest in the business. So you
mm-hmm,
look at this business and you think that, oh, in 10 years' time, this business will be bigger. So today it is selling cheap, in 10 years' time, I think when it's get bigger, it will be more valuable. What I call investing based on fundamentals.
mm-hmm,
So that's a tougher one to do because to do this, you need to understand how business works.
mm,
Because if you don't understand how business works, how are you going to judge whether the business is good or bad? Okay,
mm,
if we just think of the Nokia and the Kodak of the world, looking at brands and business superficially is not good enough. So you need to
mm-hmm,
understand the business. So
mm,
this is the second method. The third method is what is known as called factor investing. Okay, see, factors are things that people have studied and analyzed, and say these are the characteristics that define returns. So, for example, value. You buy cheap stocks, value stocks. In long run, you'll be better off. If you buy stocks with momentum, okay, it's a technical momentum, it will do well. So there are people have identified factors, and there are whole series of things that grew up on what we call factor investing. So you identify these are factors that have defined success. So I'm going to invest in these companies. We demonstrate these factors, what I call factor investing.
Mm.
And then the third one, which what Warren Buffett tells everybody, if you are not good at reading crowd behavior, if you don't understand business, if you don't understand factor investing, then buy the market, buy the index.
Mm.
Okay. Over the long term, the index will give you, the Malaysian index will give you 6 to 7% return per annum.
Mm.
It's not too bad, 6 to 7% compared to your inflation rate 3 to 4%. So you
Mm.
don't have to know anything. Sorry, you need to know a bit. Okay, in the sense that when you buy the index, you buy long term. So you buy
Mm.
regularly, and you don't worry about whether the market ups or down, because you believe that over the long term, uh, the stock market will go up. And the reason I say that is because you see the economy of the country is related to businesses. Okay,
Mm.
it's goods and services, of manufactured and product provided by companies.
Mm.
And the stock market represents the best companies in the country. So if
Mm.
you believe that the economy of the country will always grow, then the stock market, which represent the best company, will continue to grow. So the
Mm.
index will continue to grow. Okay, it's a philosophy. But so if you, of course, believe that the country has no future, then don't invest. But if you believe that the future, the country has future, then the stock market will continue to grow, and you just buy the market now.
Mm. Yeah,
So you
I
don't
think
need
to
to, yeah. So what I'm saying is you don't need to be very clever to invest the market. Okay, just buy the market. It's just that you don't have to be greedy, because most people, when people invest in the stock market, it is because you want to do better than neighbors. You heard these stories, and so you get greedy and you think that wow, the market is not good enough. I want to beat the market, and that's where you fail.
Yeah, I think to sum that up, like I think everyone started investment like from different background, from different route, but I think throughout time people will understand that maybe they fall into a different category of like the way they are investing. They are different kind of investors, but throughout time maybe we get better. We maybe from the start we are just like you say follow the crowd, or like just blindly investing, and slowly we start to learn the fundamentals. Throughout times, maybe we find out that there's a different way to invest as well. But it just means that investment doesn't have to be like that complicated, like what we think it is. Especially investing in stocks, because the only reason why like most people find it complicated, it can be really because they haven't started yet, so they
Uh,
haven't put themselves
it's more than
into the.
that. Because my advice for those of you who want to start investing is
Mhm.
start with the index. Okay, so
Mm,
you park your money with the index, and then it generates some income while you're learning. Because to learn how to invest, I reckon you'll take it 2 to 3 years. Okay, it is not something you will learn in 1 week, 2 weeks, 3 weeks. Okay, you need time to learn. And
mm,
if you park your money with the index, then you can generate some money, and it can be a reference point for you to check and see whether what you have learned, you can actually do better than the index.
mm,
Now,
mm,
the point about investing, okay, we all speculate when we're young, okay, because it's fun more than anything else. Okay,
mhm,
but as you grow older, my advice would be is that there is a personality and behavioral element in the investing style you do. So I've tried investing based on what I call market sentiments. Okay,
mhm.
I found out that I couldn't make money because I'm not very good at reading the crowd. I tried factor investing, doesn't work as well. Okay, so one of the things that I've figured out over the years is that I think you need a certain mindset for each of the different styles. So
Mhm,
you need to find a style that fits your mindset. So if you don't have that particular mindset, after a few rounds of failure, switch and try something different.
mm.
Because there are different things available in the market.
Yeah. Thanks for sharing your experience about investment, which keeps yeah, the advice to everyone who's listening is really just by starting, and then then you figure out what whether this style suits with the way you think, whether it resonates with your mindset or not. Then let's go to the next question, which is something personal about you, which is, what is your favorite quote? Like that your favorite life motto, something that you live by.
I I I because I studied at the Royal College. I have this motto which the British commando has, the
Mm-hmm.
special air services. Okay,
Mm-hmm.
and it is who dares wins.
Mm.
Yeah, simple
Okay.
motto. Okay, because they're commandos anyway, so their motto is who dares wins. Okay, and I thought,
Mm.
hey, yeah, okay, actually that reflects a lot of things in life.
Mm-hmm.
That if you want to make it big and do something different, you have to act differently. Okay,
Hmm.
so if
So,
you don't want to, if you want to stay within the comfort zone, then you only get the comfort results.
yeah, I think that resonates with many people as well. I think really like is with the courage, and the minute when you decide that you just want to get out of the comfort zone, that's when you get a different result. Maybe the first try you might not get the result that you want, but multiple tries, that's when we will get there, right? Okay. The last, like, quick fire question is, I'm gonna ask you a very random question, which does not might not might not have to make sense, but basically out of two option, is generated like automatically from a question generator. So you're supposed to just pick one out of the two options, which I will read out the question to you. All right. The question is, if you were forced to swap bodies, you would swap with either Donald Trump or Cameron Diaz.
Yes, of course, lah. You're beautiful. People chase after you. What is it that you don't want?
Okay. That's interesting. Well,
Donald
but
Trump is scared.
maybe you get a different result if you get Donald Trump's body. Like maybe he's someone with with rich and power. Maybe you can demand different things. With believing in his body as well. So you think it's Cameron Diaz? Okay, what would you do if you live in her body?
Be actress. That would be
Interesting.
that would be the easiest way to what they call it, to have a quantum leap in income level.
Interesting. All right, for our audience, maybe that's can be a good like word of advice as well. Thanks for that. Well, that is definitely like random. So, whoever like just joining us today, we're gonna talk about how to mitigate risk while investing, together with Dato Eu, who is the blogger, the person behind I4Value dot Asia blog. So let's check out his blog, and we're gonna start off by asking, what are the different types of investment risks out there?
Well,
So,
before I start, I think
mhm,
we all of us who actually goes into investing seriously
yeah,
always believe that your focus is to protect the downside. Okay,
yeah,
don't worry too much about how much you're gonna make. Okay,
hmm,
worry about how to prevent losses.
hmm,
And to me, investment risk is basically ending up with less money than what you started with. So, for
hmm,
example, if you have 10,000 to start with, and at the end of the day you end up with 5,000, your loss is basically your investment risk. So when I talk about investment risk, I'm
hmm,
saying, uh, how do you ensure that at the end of the day you make more than what you started with rather than you make lesser?
yeah,
Okay,
definitely.
so that's my idea of investment risk.
Mm-mm,
And the reason I focus on investment risk is because it is a tough one. Because when you look at the literature of investments, of risk, okay, There are actually two schools of thoughts when it comes to investment risk. I've got a slide on that to illustrate what I mean. Okay, see there are people who think that volatility is a measure of risk. So, for example, if you buy a share at $10 and it goes down to $9, $9, and then next day it goes up at 9.50, and then it fluctuates between $9 to $10. Uh, Many consider that as a risk. Okay? Now, I follow the other school of thought, which says that it is only a risk when you actually crystallize a loss. So everything else is a paper loss, and paper loss is not a risk, and that's why many coin this word called permanent loss of capital. That a risk is one where you have the threat of losing, suffering a permanent loss of capital. If there's no threat to suffering permanent of loss of capital, then there's no risk. Now, the sad part about this risk is that when you look at investing and you try to look at all the ways in which you can prevent the risk, there's a lot of literature about volatility as a risk. Okay, and the reason is because it is a mathematical construct. Okay, volatility, you can define it as variance. You can read a standard deviation, and because you can treat it mathematically, the academics have come out with a whole series of things on how you measure volatility and how they have equated volatility with risk. Now, to most of us, especially the retail investors, and especially if you have a long-term perspective, volatility doesn't really make sense, because as long as you don't sell, and as long as you have mitigating measures, to prevent you from selling when times are bad, then it's not a risk. That's why I see risk as the threat of permanent loss of capital. So to me, that's looking at risk from that perspective now. So the challenge then is, when you talk about mitigating risk, or when you talk about preventing risk, then your idea is, how do I ensure that at the end of the day I don't get less than what I put in. Now that's the idea of risk. Now, before we talk of risk, I have, you see, if you're looking at investing, okay, I like to look at investing from the perspective that the reason you invest your savings is because you want to protect it against inflation. So if you have money and you keep it under the pillow, okay, you are really at big risk, because eventually if inflation will eat your money, okay, forget about it being stolen now. But even if you do anything, in 10 years time, what you have under the pillow is going to be less. So your basic idea is that whatever savings you have to invest. If nothing else, at least to protect it against inflation. Of course, if you take it from the perspective that you are protecting against inflation, you want to earn more than inflation. So for those of you who are thinking of investing, my advice is, think of it from a global perspective first. You got X dollars in your savings. Okay? Divide your X dollars into 3 buckets. Okay, what I call my 3 buckets strategy. The reason I say this is because when you invest in the stock market, it is volatile. So you don't want to be forced to sell at the wrong time because you needed money for emergency. So what you do is you look at your investments, look at your savings, put an amount in bucket 1 where you don't touch. This is in cash form, that is to cover your emergency. So if you lose a job for 3 months, you don't have to sell the stocks, okay, at the wrong time, because you have this emergency money. What I call bucket 1, and this is cash. Okay, so in the Malaysian context, anything you keep in a bank, FDs, this is your bucket 1 that you keep. And personally, what I have is I have 2 years of annual expenditure kept here, so that in 2 years, if I have problems, I don't have to sell my stocks. So what I call bucket 1. Now the second thing is that you then have bucket two, okay, and again coming from a risk mitigation perspective, bucket two are those investments that the principal is protected. So in Malaysia, if your money in EPF is a good example, okay, you will never lose your principal. In fact, it should go up. Okay, if you invest in Amanah Saham, another
Mm-hmm.
example, this is another investment that protects your principal. Okay, so when you look at the amount we have, part of it goes to bucket one, part of it goes to bucket two, and again, I'm very conservative, so I have 8 years of my net worth in bucket two. Now in Malaysia, I say EPF, I say Amanah Saham, I will put your own house, the house in which you're staying, inside there as well, because you're not going to sell it. Okay, you know that you
Yeah.
hold it for 30 years, you've got value, so your principal is protected, and
Yeah.
then the remaining amount is the one that you invest. Okay, you invest in Bitcoin, invest in stocks, invest in what I call the risky assets. Those assets where you can lose all. Okay, those assets where there's a huge amount of volatility. So when you look at risk management, look at from a global perspective first. Okay, because if you go through this three bucket plan, eventually you'll find out that you can identify the amount you set aside for what I call the risky investments. And if you divide your risky investments into commodities, into stocks, and into Bitcoin, you can actually come to an amount of, say, this is the amount I'm going to allocate to stocks. So
Yeah.
when you look at
That
it from
makes.
this perspective, sorry, yeah, what I'm saying is that this is global perspective. Okay, you protect your wealth. You want to earn more, but at the same time, you want to lose all. So I have this uh, asset allocation plan, for one of a better word. Okay. The
Yeah.
traditional
Correct.
allocation plan talks about bonds but I think it from a different perspective. I think it from, say, hey, if I lose all in my stock market tomorrow, I still have my savings. I still have I still have some base that I don't lose all. And
Yeah.
that's my
Definitely.
advice to everybody who wants to go into the stock market. Think along the lines.
Yeah. But that makes me wonder, like, for some people, they might not even have, like, actually, for many people, they might, we won't even have, like, 2 years of annual expenditure, to be as the bucket one. Does that mean, like, we don't start investment?
Yes, but see, the bucket one is, you see, the objective of bucket one is this, that you do not want to sell your investments in bucket three at the wrong time. Okay, so because it's volatile, so when it's down, you don't want to sell because it's down, so you want to be able to hold it for, well, COVID, we were down for 2 years. Okay, so you want to be able to hold it for some time. Now if you are young and you got your parents to support you to the backup, I think you can play with your bucket ones, where your emergency fund comes from. Okay, so it doesn't mean your own savings. Okay? If you work in a job that you don't get retrenched, I think your income there is part of your bucket one, your work income. Okay, so there are elements inside there and not just pure savings now. But of course, if you're a retiree, okay, you got no other backup, then your savings has to be from bucket one.
Yeah, correct. Yeah, I think, this whether this person is in a different kind of life stage, throughout their life, plays a different role when it comes to this type of asset allocation. I think, and of course, generally when it comes to, like, emergency funding, we will say that we need to have at least 6 months of our expenses. That includes our, financial commitments, our expenses, and, even our savings. Now, that is a bare minimum. But not just that, we also have to make sure that we actually do set aside what we might need to spend, when it comes to our, some normal expenditure. That comes, that for that, cash flow management comes into very, very big, important part of it. That's when we will know how much do we exactly have to have in this bucket one, when it comes to this three bucket strategy, right? So yeah, and also I think, um a good summarize is also that bucket two, it just means that those money that we set aside, that we know we won't lose the principal, typically like the lower risk, low to mid risk kind of investments that are set for, long term. Then whatever we have in bucket three, that's when we go for investments that can bear the risk, right? I mean, okay, I will change the way of saying not the risk, but the volatility.
No, the risk, because even if you leave aside the question of volatility, okay,
Hmm.
there are risks investing in stock market, there's risk investing in Bitcoin, there's risk investing in commodities, and forex and all the things that you want to put in bucket three.
Yeah.
Uh, Now, that's what I call the global perspective. Okay, you need to have this global perspective so that you don't risk all. I think that's the first
Mm,
question about risk management. Now, the
yeah.
second thing is that when you look at bucket three, okay, for each of the assets there, for example, stocks, or even Bitcoin, or even cryptocurrency, or even commodities,
Hmm.
don't invest in one instrument. Okay, have a
Definitely.
portfolio. So when
Yeah.
you have stocks, you should think in terms of a portfolio of stocks. When you have commodities, think in terms of portfolio of commodities. Crypto, you may have different type of crypto, but the whole idea is again risk mitigation. Okay,
Yep.
because if you invest in one and the one thing tanks, then you don't have the protection. Whereas if you
Yeah.
spread it out, okay, if one does badly, then of course the others, hopefully you do well enough to offset the bad ones lah.
Yeah.
So again,
Definitely.
this is a risk mitigation strategy that you must have. Okay.
Yep.
Now, for
Definitely.
those of you investing based on fundamentals, it
Hmm.
means buy more than one company. Okay.
Hmm.
And then the question is, how many companies do you buy lah? Okay.
Mm.
Now, studies have shown that the more you buy, the less the amount of returns you get. The lower the risk, the less the returns lah. Can you imagine if you buy one company, for example,
Hmm.
okay, and it goes up 10%, it is 10%.
Yep.
If you
Yep.
buy two companies and one got 10%, you need the other one to go up 10% as well. So the more you
Exactly.
have, the less in terms of quantum you get, but you lower
Yeah.
the risk. Okay. So the
Yeah.
question is, how many stocks do you have now? Now, people like Warren Buffett says, I'm very good. I hold concentrated portfolio. So they talk about 10 stocks and so on.
Hmm.
I would recommend that you go for about 30 stocks, because
Mm.
studies have shown that the benefits of diversification becomes marginal after 30. So if you get
Hmm.
50 stocks, the additional benefit you get is not there. So
Mm.
if you have about 20 to 30 stocks, I think that will give you a diversified portfolio.
Yeah, but I think that might also like the question might also be like, for someone who actually like just starting, for the like new share investor that just starting to construct a portfolio, like how should they like go about it?
Well, so come back to the next question then.
Mm-hmm.
So if you're going to choose 30 stocks, then you're
Yeah.
going to choose 30 stocks based on an investment process that
Mm-hmm.
protects your investment.
Yep.
Okay. So if you choose 30 stocks randomly, then you're an idiot.
That's a
So
strong word to use.
yeah,
Yes,
but,
but
but
pretty
basically,
much.
that's the point. Doesn't mean that you choose certain stocks. You must well buy the market. You know,
Uh-huh. Yeah.
buy the stock
Correct.
market. And be assured that you get the returns there. So
Yeah.
the idea is that if you're going to construct a portfolio, then the
Mm-hmm.
question is, how do you choose the stocks? And I'm saying to you, choose a stocks based on an investment process that more or less protects your downside.
Mm-hmm.
And that's where I'm coming from. That I'm a value investor, because at the
Mm-hmm.
heart, value investing is buying stocks that is trading at a discount to its value.
Mm-hmm.
And so if you're buying things cheap, hopefully in the long run, when the market realize the true value, then you have a chance for it to go up. If you're already buying at a discount, less chance of it to go down lower.
Mm-hmm.
So that's my idea of how do you going to select the stocks. Select the stocks based on value investing principles. Now there are many ways you can select stocks. Okay, but
Yeah.
those those that
Maybe
invest
like
based
a
on principles.
it.
Okay, I
Sorry.
say
Sorry.
invest. You say if you invest based on market sentiments,
Mm-hmm.
okay, there are techniques that helps you prevent risk. There are risk mitigation measures. You know, so
Mm-hmm.
for example, if you are a trader, then people use stop losses. Okay, and there are
Mm-hmm.
technical way in which you say now how do you calculate a stop loss so that you don't lose all. You know, there's technical way in which how do you determine how much you invest in each stock. You know, so that so each style has its own risk mitigation measures.
Mm.
Okay? Uh,
Yeah.
I like fundamental investing because there are logic to the way in which you can take steps to prevent threats of permanent loss of capital.
Mm, mm. Yeah. Then, in your opinion, what are the risk mitigation approach that are basically answer the common questions out there for people who are just starting to invest in stocks?
And that's the one that I spent years looking for this answer. Okay, and
And we're so glad to have you here with the vast experience, many years of experience, your hands-on investing, and also from your risk management community role, that that you can basically give us the summarized answer.
okay. I'll give you the short version.
Hmm.
If you look at literature of risk management, okay,
Hmm.
all you're going to find are a lot of things written on volatility as risk. Okay, and
Definitely.
it's not going to help you. Okay, so when I started trying to figure out how to get a systematic approach,
Hmm.
to mitigate risk,
Hmm.
I went back to the corporate world. I think is the word I use. Okay, see in when you run companies and in businesses, risk mitigation is one of the key things that the company does. Okay,
Hmm.
and the corporate approach has evolved over the last 30 to 40 years lah. But
Hmm.
conceptually, what it says is that to mitigate risk, okay, then your first thing is to identify the causes of the risk. So if you see risk as permanent, as a threat of the loss of capital, then you need to identify which are the ways in which you can lose capital.
Hmm.
Then secondly, in the corporate world, you may have 30, 40 risk items. So
Hmm.
your job is then to identify and assess the impact of the risk and the likelihood of it occurring. Okay,
Hmm.
so if it is high impact, you give it more importance. If it's high probability of happening, if it's more importance. Those with low impact and low likelihood, you just ignore it and don't spend your time. So
Hmm.
so you sort of whittle down and say, let me focus on the key risks, and the key risks are those which has high impact and high likelihood of occurring. Then
Hmm.
of course, once you have identified the key risks, then you figure out and say, how do I prevent, or what do I adopt to mitigate this risk?
Hmm.
Okay, and I guess over the years, tinkered with this and come up with a framework to address this issue.
Hmm.
So the first thing is, if you think about it, and you think as risk as, in 10 years time, my $10,000 is going to go $5,000. What can cause this reduction in value? Okay.
Yeah.
And I use a thing that I used when I was very young those days as an engineer, called the
Hmm.
Ishikawa diagram. Okay, the fishbone diagram. Okay, and this is a diagram where you draw, a fishbone. So the head is the problem. So in a factory environment, you say I got 10% defects. Then you figure out, what is causing the effect. Is it
Hmm.
people's problem? Is it the purchasing problem? Is it the process I use? And is it a machinery problem? So you try to identify the causes, and then for each of the cause, you try to identify sub causes,
Hmm.
and you lay it out into what I call the fishbone. Okay,
Hmm.
and this is a technique, and it's called Ishikawa because it is actually a idea developed in Japan,
Hmm.
and we use it for defect identification. You know,
Hmm.
and I adopted this idea and says, look, if I say that risk is permanent loss of capital, then which are the ways that I can lose my capital lah. Okay, and I then look up all the literature on the ways in which I can lose money, and I set up my own Ishikawa diagram, okay, based on this permanent loss of capital, and I've grouped them into 4. Okay, so if you buy a stocks, okay, thinking that it will go up, and you actually buy a Kodak, in 10 years time, no matter what they do, the value will drop. So there is you can have a deterioration of the value of the company, okay, because of external forces, because of digital disruption. Okay, so you want to identify all the causes of that. The second group of causes is what I call portfolio construction, because when you construct your portfolio wrongly, okay, that means you invest blindly, or you choose a stock wrongly, and so on, you can actually lose money. The portfolio can actually lose money, okay, even though 1 or 2 stocks may make. So you want to make sure that when you construct your portfolio, you choose the correct stocks, you invest the correct amount in each stocks. Okay, so there are things in what you do for the portfolio. And then third thing is that I use the word wrong initial intrinsic value, because when you investing based on fundamentals, you're assessing the prospects and the value of the company. So you can make mistakes in your calculation. Okay, you could make the wrong assumptions. You could make computation errors, and I've had computation errors. Okay, so what I do nowadays is that over the years I have a standard Excel worksheet, and I will tell you that over the past 15 years, every other year I find, I made a mistake in this worksheet. And you find out that I hopefully now have a worksheet that has eliminated all the computation errors, because you're working numbers. Okay, so you can get sidetrack, having a wrong process.
Yeah.
And then the thing is that there are stock market changes. Okay, you buy a company, and then suddenly the company decides to privatize. So all your idea of how good a company goes out the window, because in Malaysia, okay, when you privatize, okay, they privatize based on market price. So the investment advisor will say, it is above market price but below the fundamental value, so it is unfair but reasonable. Whereas in Singapore, the rules are different. In Singapore, any privatization has to be on basis of being fair and reasonable. So it must follow market price, and follow the intrinsic value as well. Whereas in Malaysia, the rules are different. So I have lost money because I bought shares thinking that was cheap, and then they got privatized at the price cheaper than what I bought it for. So I've set up this framework to identify all the potential causes. And what I've done is then for each of them, I do the assessment, and that's basically taking it from the corporate perspective, have a matrix where on one side I have the probability of, can I have the next slide, of something occurring? Yeah, okay. So this is how I assess it, okay? So on one side, you have the probability of something happening. On the other side, actually you have the impact. And I colored it. So low impact, low probability is a green. High impact, high probability is a red. So all the 20, 30 possible causes, I fit them into each boxes. And then my job is that for the red one, I must have a way to prevent it, okay, or to mitigate it. For the green one, I don't worry so much, okay. For the yellow one, okay, I don't worry so much, okay. For the orange one, okay, I worry a bit more. So I have this framework so that I can focus my effort. And then we come back to what do you do now, okay, to mitigate risk. And again, you go back to the corporate risk management, which they have four clever ideas, okay, broad ideas on how do you mitigate risk, okay. Can I have that? So basically, if it's green, just accept it. Don't bother doing anything. Okay. You can avoid the risk. Okay. That means if it's too risky, you don't buy the shares, even though it looks good, okay,
Mm-hmm.
you could transfer it to another party, okay, and there's hedging for those who becomes much more too clever. You do hedging and so on, or
Mm-hmm.
you can reduce the risk, lah. Having a portfolio example of reducing risk. So there are various ways to do each of them.
Yeah.
And what I've
Do
done
you
over the
do you
years,
have some, yeah, sorry, Dato. Maybe you have some example of like at what situation we, scenario of when we can accept, when we need to avoid, maybe some,
okay.
real
So
life
I've
example that.
actually provided, and I think it's too small. Okay, a slide for you where I've actually summarized what I've used myself.
Mm-hmm.
Okay, into on the column side, I have the three strategies: avoid, reduce, and accept. And then
Mm-hmm.
in each row, I have the various categories of risk. Okay,
Mm-hmm.
and for each of them, you know, for example, for to avoid the stock market risk, and I focus on quality companies. So this is an example of
Mm-hmm.
avoidance strategy. Okay,
Mm-hmm.
for stock market risk, diversification in portfolio is another example of reducing the risk lah.
Mm-hmm.
Okay, uh, now the transfer one is not on the list because I then have my other investments. Uh,
Mm.
invest in properties. I invest in bonds. As my
Mm.
other transference of risk concept lah.
Mm.
So
Mm-hmm.
for each of these, over the years, and every year I look at them and I say, hey, is there something else I can do, okay, which is different?
Mm.
And this is what I've been doing currently, lah. In terms of conceptually, the various things that you do in your stocks and in a portfolio.
Mm-hmm.
It's conceptual, but this is like I said, I have it in my blog. You can go in and have a look if you want
Mm-hmm.
to get the ideas of what you want to do. Okay, but
Yeah.
at the end of the day, it is when you think of it, it's all common sense, lah. Okay, taking a
Mm-hmm.
common sense approach to ensure that you address each of the threats.
Yep.
Okay, okay, and
Yeah.
uh, uh, when you think of it, nothing very clever, lah. Okay, it's
No, definitely this is something that is very clever, which is why I asked for example because yeah, I mean it definitely takes like experience for someone to, construct this whole thing. I mean we are thankful that we have the previous one that this basically the fishbone framework that you basically like came up with, which you can for the starter we can definitely try to refer to this and then try to identify the risks when we are trying to work on our stock investment. I think that's definitely helpful, but then it really comes to like what is the real life like examples of the different scenario when it happens, and also the important things like when do we actually act on it, whether it's the right time to accept, or whether it's the right time to avoid, and at what situation and how can we transfer to another party, and at what situation when we know that okay, this is something wrong, we need to stop, right?
yeah.
I think it definitely takes a lot of experience.
It's I don't want to use the word experience. Actually, it takes a lot of losses. What you're saying is probably 20 years of bad experiences. Okay, and every time you kena one, say, "Ayo, how come I didn't see it?" Then you edit in. Okay, so if you are investing for the long term, the
Hmm.
reality is that there will be times when one or two of your stocks tanks. Okay,
Hmm.
if you tell if you say you don't have losses, in at all, then something is wrong. But
Yeah.
what you hope is that over the long run, the gains more than offset the one or two losses that you have. Okay, and
Yeah.
and that's where the portfolio comes in, and that's where looking at individual stocks, and trying to understand why you lost one particular stock, and trying to build that into your risk mitigation measure becomes important.
Mm. Hmm.
So I've
Yeah.
like I said, for each of the category, I've got losses, I wish I didn't have them. Okay? And I've
Those are
got
all valuable experience, and yeah, good loss,
loss.
because because I would say like at least, I mean, the money was gone, for that particular time, but what we gained was really the things that the lessons that we learned from all the losses, right?
So that's so the most important thing, and to come back to the lessons is that if you're going to learn any lessons, then
Hmm.
there is no substitute. Okay, I'm going to put on my corporate hat. There's no substitute for having a standard operating procedure on what you do. Because if
Hmm.
you can document what you do, and you can have
Hmm.
like for me a standard worksheet and so on, then
Hmm.
whenever every year when you review, you can check what you've done against what you say you were supposed to do, and
Hmm.
that's a fantastic reference point to
Yeah.
enable you to change your process, to enable you to change your formulas and so on. Uh,
Mm.
and that comes with certain amount of discipline. That, that if you want to invest and you want to learn from what your mistakes and so on, you need to take a disciplined approach, and not simply let's go Robin Hood and then press this button, press that button.
So yeah, does that mean like your very useful tip will be to document everything that we have done and how we
Yeah,
have
because
changed it accordingly?
each of us has our own investment process. Although the general principles apply, each of us, uh, would tweak it to the way we see the world and the way we experience and so on. So each of the all investors are different, okay, in different ways. So each of us has our own way of calculating, each of us has our own way to judge things and so on. And so what you can do is, if you don't document what you do and you start reading what people have done, sometimes you get confused. Okay, so
Mm.
that is the best advice I can give. That if you want to improve, you must have a base in which to refer to.
Yeah, I think that is such a useful tip, is because um yeah, I mean, we all know that, we are paying something, to learn from all these like losses and mistakes, and we don't document it and we don't change it, like once we realize that it's, something must be done wrong. But of course, maybe for the first time we can't really identify what was wrong, so that takes some multiple times of try and error. But if we don't document it, like there's no way we can really remember what was done previously, and what are the things that we need to change this time, so that we don't repeat the mistake, right?
Yes. Hmm.
Yeah.
It's like I
Well,
said,
so
hard work. Okay, there's no such thing as a passive income. Sit around, money falls down from the sky.
well, maybe like hard work, might, but this term itself might be scary to some people. But I would say, if you enjoyed learning this, take it as a very fun and interesting learning process. Basically, yeah, there might be some mistakes that we make, some lessons that we learn. But if you enjoy the process and you really realize that you are learning something out of it, it's hard, but it's fun work. Can I put it that way, Tato?
Yes. I use hard work. Okay, but I come back to my point. Okay, you have if you're not passionate about it, then you won't love it and you won't do it, and that's the end of the story.
Yeah.
Then go
Yeah,
and buy
exactly.
lottery, look for a rich girl, or hopefully hope your parents are rich enough.
Yeah. So, well, with your long years of experience in like value investing, and your whole journey in like value investing, what was your most unforgettable like experience in this whole journey?
Most unforgettable one is you come back. The X file molder, trust no one.
Uh-huh.
You when I first started, okay, I played a lot of emphasis on these rating agencies rating, people's
Mm,
recommendation and so on. Then at the end of the day, you know, when you follow them and you lost money, you say, hey, I'm not going to trust anybody else. I'm going to trust my own analysis and my own valuation,
mm,
and that's
mm,
so. Because at the end of the day, especially if you're a fundamental investor, okay, you
mm,
need to understand why you are investing in that company, and there's no
mm,
shortcut to it except to do your own analysis. Okay, looking at what other
mm,
people have done can give some ideas,
Mm-hmm.
But then, I'm very cynical, looking at rating agencies and so on. They're making money. Okay,
Mm-hmm.
if you look at what happens at the financial crisis and so on, uh,
Mm-hmm.
I'm going to say very bad things about agencies and so on. But it's with hindsight. Okay, so when the things are, they can't give you they can give you a rating of good companies. They can't give you a rating of bad companies when it's going to
Mm-hmm.
turn bad. Okay,
I
and
see.
that's a tough part about investing lah, because imagine the best example is, think of Nokia and Kodak. Okay, in the heydays when
Mm-hmm.
you were investing, who would have thought that, hey, Nokia will be gone for this world, the Kodak will be gone for this world, you know? And the rating
Yeah.
agencies would have given you fantastic rating, I'm very sure. So if you are investing and you're buying companies for 10 years, 20 years, you know, you had it. So it's a tough one.
Mm, I see. Well, that's a valuable like advice as well. I would say, put it in a different way. Just take all these ratings with a pinch of salt, and put in, maybe for some, maybe there are things that we can refer to. To make it like less hard work. Maybe there are something that we can refer to. Which they've done the work when it comes to evaluating like some of the stocks, but take it just from that itself and like add it with
Yeah,
our fundamental analysis. Is that what how we can put it?
yeah. My advice for those who are on this young, okay, the platforms targeted the young. Okay, take what they recommend as a pinch of salt.
Mm, yeah.
Because then you've lost out on GameStop and you lost out on Bitcoin. You could have been multi-millionaire to GameStop and Bitcoin if you follow my advice.
Oh, thanks for that advice. Well, thank you so much for all the sharing that you have done. Your from your own experience, and then your explanation on how we can mitigate the risk. Based on proper approach, instead of like just investing blindly. So, if there is one big audacious habit or goal that you want our audience to just take action and then just start doing it right now, what would that be?
Well, if you are going to invest, okay, and you're going to buy a particular company, write down the reason why you're buying it. After you sold it, come back and check
Mm,
and see whether you're right or wrong. One sentence, two
wow,
sentences of why
I
you're
think
buying the
that.
company. That's a fantastic learning opportunity. Most of us are
Oh,
then
I
not look
think
at
that
it.
is a.
Most of us then not look back. Unless it's a winner, you then not look back.
Yeah, like that takes a proper like documentation, like system to actually store it and write it in a proper place instead of like a blank paper and then after 1 year you just lose the paper already. Yeah, but I think that's such a good tip, which is to write down the reason why you choose that stock, right?
Yes.
Yeah.
You
Right.
it's a very sad thing, but you're going to learn more from losing money than making money.
Oh, that is definitely true.
Yeah, when you make
Well,
money, you think,
because it
wow,
hurts to lose money.
because when you make money,
Because
you
it
think,
hurts.
wow, because when you make money, you say, wow, I'm a fantastic analyst. Wow, I'm so good. Look at me, look at me. So you're not going to learn anything.
Yeah, well, it's all also because like it hurts to lose money, so people tend to remember it that way. But I think it's so important to move out from the negativity of like wow, ouch, it hurts, I lost the money. Instead of that, focus on what why it happened. There must be something that you have done wrong, wrong way in like analyzing, or maybe back then you were just not too clear with the exact goal of why, the reason of why you chose that stock. That's why that's so important to write it down. And then that, but how long, like would you advise for us to how long is the duration for us to refer, go back to the piece of paper or where we wrote.
Go back to the question. How long does it take to learn to invest? Okay, and I tell you this analogy. All these young people, okay, when you say drive a car, most of them will say, let me learn to drive a car first before I jump into the car. But when it comes to investing, they don't care. They just jump in and press the button first. Okay. So why when you drive a car, you behave differently than when you invest? Okay, that's something that I don't understand. Okay, so but come back to my
Yeah.
point. If you want to invest, then learn to invest. Okay, and that will take time. Okay, learn to invest. Okay, there are many options. Okay, uh, there are, and nowadays, unlike what my time when I first started, there are many online materials, free online courses, and so on that you can actually learn to invest and so on. The trick is to focus. Okay, don't try to be clever and
Yeah.
learn, or how to read the charts, how to be fundamental investing, how to do all the 1,001 things. Focus on one or two things,
Mhm.
and then slowly build up. Because investing is a skill,
Mm,
and skill development needs
mm,
time. And
mm.
the best advice I would do is that don't invest in real money nowadays with apps and training programs and so on, simulation and so on. You can actually do paper transactions. You can do simulations, and make sure that only after you have made money on paper or simulation you actually invest in real money. That would be the best advice I can give to people. Unfortunately, most of you are not going
Mm.
to follow it because it's no fun. You see,
Why not?
no fun. Okay. So, wow, I mean, I got to paper investments before I actually invest in real money. No fun. But that's basically what you
Mm.
should do. We got apps.
Yeah, yeah.
Paper invest. Spend a couple, 1 or 2 years paper investing. Make sure you can beat the index. Then do real money. Then you don't have
Wow.
your learning curve is basically on paper, virtual.
Well, that made me realize that this is the first time you actually recommended like us using some app, to actually do
Yeah, play with it.
something.
Paper money. Use paper money. Transact with paper money. Learn from paper money. Why use real money? In those days, when we don't have the apps, it was a much tougher thing to do. When I first started, information had to come from newspaper. And then sometimes
Mm,
you miss one day paper, then you had it. You have apps
mm,
nowadays. You can get information live. There are simulation apps as well. That you can use
mm.
to trade, to buy, invest. All you need is to develop the habit to treat it as if it is investing it for real, and you keep records and so on.
Yeah, yeah. I think that's so important, but I totally understand, that is a very good advice, but it's not easy to follow because
Yeah,
most
don't do
people
it.
just wanna,
Okay.
no, I
Then
just
they
wanna
go to
try.
test button.
Yeah, I know. Then they will forever be in that kind of cycle where, okay, I want to try, so let me just dump this amount of money that I think I'm comfortable with, to just try, and then. But after a few rounds, after a certain amount, okay, I'm not comfortable. Like it's exactly like the analogy that you use, which is they just jump straight out of the car and that's it without staying in the car to continue learning how to drive properly and understand that it's a long process of learning how to actually invest,
Hmm.
right? well well, thank you so much for all the sharing. I definitely learned so much from you, like all the interesting example scenario, and yeah, all the experience that you shared. So if there's any one last thing that you just wanna share with our audience, is there anything that you wanna shout out
Yes,
using this
you
opportunity?
must invest. Okay, if you take the view that you're preventing your savings from being eroded by inflation, you must invest. So learn to
Mm,
invest. That's the best way. If you want to learn, okay, and in Malaysia you have this facility, dump your money to EPF. Okay,
okay. Well,
hey, you can put that. You can put additional savings on EPF under the current scheme. Okay,
mhm,
and let them invest for you, or at the worst, go and invest in amanah saham.
mm, yeah,
Okay,
yeah,
then once
yeah,
you
yeah,
build up the base, then go and speculate. Then you
yeah,
you
yeah.
you
Yeah, I understand, because that actually goes back to your three bucket strategy, where at least someone is actually working on the second bucket already, which is the bucket
yeah.
two of like something that it's not too risky, but at least it's you have someone investing for you, and it's with at least it beats inflation instead of
Yeah.
just having your money all sit
Yeah.
in
Mm.
banks or yeah, under the pillow, right? Okay. All right. Thank you so much. So, yeah, I'm really thankful for having you on this show today. I believe that, things that you can talk about, topic on, how to actually like invest properly, how to properly like, even better manage how to properly like execute all the risk mitigation approach that you talk about. It takes maybe more than 1 hour more session like this. Actually, waiting for you to be on the show again to talk about a different topic, maybe something that that will help all our audience.
Then when my book comes out, somewhere in July, August, we can come back.
Oh, that
And
that is something that I would definitely look forward to. So yeah, and also shout out to our audience. Keep an eye out for Dato Eu's book, which will come out in July, right?
yep.
Yeah, that's pretty soon. And then we will definitely have a session to have a chat about the book that you actually put on. But I'm pretty sure that is any sneak peek for the book that you're writing.
Well, it is about value investing with a risk mitigation mindset.
Mm-hmm.
And unfortunately, uh, it is for the serious investor. So for those of you who want
Mm.
to play, please continue your app.
Oh no! Well, that's a bit discouraging. No, I'm pretty sure there
No,
are many things that audience can learn from your book.
I wrote the book, okay, targeting people in the late 30s because I think that by the time you reach that age, you are probably married, have some children, and then you probably think, okay, enough of all this speculation. Really, I'm going to seriously look at how to make money, from stock market. Then maybe you buy the book.
All
So
right. Okay.
when you're too young, you probably not interested. You're going to buy the Robin Hood manual.
Okay. Maybe like the age comes into a certain perspective, but I believe like for someone who has actually like been through some sort of investment journey, and then they learn that okay, maybe it's time to actually take charge of their investment instead of relying on outsiders like information, and that's the time where they can start reading your book. Though. Right.
I
All
like to be
right.
proven wrong, but I like to be proven wrong. So suddenly, all the youngsters will buy my book, which I don't think. I hope so.
Yeah, we hope so. I think but we definitely like wait for you to tell us more about the book. Once it's out, and yeah, then we can learn from more from you. Then, all right.
Okay. All right.
Okay. Thank you,
Thank you.
Dato. And then yeah,
Bye.
thank you. All right. Thank you, everyone, for listening. Thanks for staying with us. I really learned a lot from Dato. I hope like all of you have learned something out of this session as well. For all the show notes and link, you can find it on our website, which is mypf.my/podcat. So feel free to comment and share the link. And then you find it useful, please share it with your friend as well. And then I will see you again soon in the next episode.